Hi everyone and welcome to this week's episode of TOOP TV. Hope you're ready to slide into the show. We're here in Hayward Park, just around the corner from some of the beautiful houses that we're selling in Unley at the moment. And we're going just around the corner to have a look at one of those homes in SA's finest. Also today, if you're thinking of a tree change, don't miss our segment on Stirling with Suburb Insider. And as normal, we're live and interactive, so send in any of your real estate questions and we'll be answering them at the end of the show. Well, good news for renters this week. Recently announced is that Adelaide's household rents are the cheapest in Australia. So if you're on the look for property at the moment, don't feel hard done by. If you're out looking to rent, we have got some of the best prices out there. Coming up on the show shortly is our Insider SA segment, and we're chatting with Ashley Manley, a renowned artist here in Adelaide. And then coming up later in the show is our inside story on first home buyers. Where have they gone and are they on strike?
Is the Australian property bubble about to burst? If you ask tax reform group Prosper Australia, they believe a falling market is imminent, with an oversupply of properties coming onto the market. As a result, they're urging prospective first home buyers to hold off on buying property, as a drop in house prices will leave heavy borrowers in financial ruin. This attempt to create a first home buyer strike is gaining momentum online, attracting almost 5,000 votes of support. But some believe this movement could create other issues.
I think there's going to be more and more demand for rental properties, good quality rental properties, and I think that's a real problem in the area at the moment. If anyone wants to rent a quality rental home, the costs of rent or the rates of rent is just so incredibly high. It makes it very, very difficult for getting into the market either way, I think.
Leading economists from RP Data, the Reserve Bank of Australia and Commonwealth Treasury dispute claims of a bubble burst though, taking inflation and mortgage rates into consideration. In fact, research has demonstrated house price growth within Australia has not kept pace with disposable household income growth since the end of 2003, which is a positive sign for buyers.
Well, some interesting thoughts there on first home buyers and where they've disappeared to. Certainly we understand that the lack of first home buyer boost finished at the end of 2009 certainly had people scurrying off and hiding, but thought they might be back by now. Certainly hoping we'll see a bit more activity over the next few months. Joining me in the studio at the moment is Tim Miller. Tim is Head of Technical Services with Cavendish Superannuation. Tim, good to have you here.
Thanks for having me here, Tim.
Pleasure. We're not going to get our names wrong, are we?
No, we're
right with that.
We're right with that.
We're going to drill down and have a little bit of a look at buying property in super trust funds and have a look at some of the pitfalls and some of the things that perhaps maybe take the romance out of the whole equation over the next few moments. But before we get that underway, Tim, perhaps a little bit of your background and where you've got involved in the industry.
Yeah, certainly. Look, my role with Cavendish as the Head of Technical Services is primarily one of education. So I do a lot of education with financial advisors and trustees of self-managed super, because there's a lot of legislation out there and a lot of it's not overly easy to interpret. So I spend a lot of the time out there educating people on issues like the ability to borrow for a self-managed super fund.
And I guess fair to say, as I mentioned, that there's a bit of romance obviously in buying property, and with the ability to buy in a super fund, it all sounds very glamorous, but there's plenty of issues. So perhaps to start us away, a little bit of a background. I've found a property, I'm ready to buy, and I want to buy it in my trust fund. What do I have to start thinking about?
Yeah, look, certainly. It's really not a matter of saying, of finding the property first and then trying to act after it. It's really important that you've got the super fund structure in place and the correct super fund structure in place. So you have your fund and you have sufficient liquidity within that fund, so that when you do go out and identify a property, firstly you've got the ability to pay your deposit and show that money is coming out of the superannuation fund, because at the end of the day the fund is the party that is acquiring the asset. Once you've done that, from a structural point of view, making sure that the banks are going to lend you the money to acquire the asset, you then need to have the appropriate trust structure or holding structure in place for the investment to occur correctly in accordance with what the legislation requires. And that's effectively an additional holding trust, and in this instance, in the majority of cases, it's a separate company that the asset will be purchased in the name of, which is separate to the name of the trustees of the superannuation fund.
And that's really important to get right, which we'll touch on in a few moments. But if I can skip back to the finance side of things, your experience on how easy it is it easy to get pre-approval once you've got that structure in place and you've put a framework to your bank manager or finance broker and said, this is what I'm looking to do, purchase price, income. Can you get a pre-approval on that basis, do you know?
You certainly can, and what the banks are generally looking for is one, that there is sufficient capital within the superannuation fund. They're going to look at the income that the property is going to be able to generate.
Yep.
But they'll also want to know how else you'll be able to fund that via contributions, other income from other assets held within the superannuation fund. So the liquidity of the fund and the future ability to meet repayments is clearly one of the issues that the banks will be looking for.
Okay. I'm now heading into happily having bought my first property, so I'm full of enthusiasm.
Yep.
Do I go out and buy my next one and throw it into the same basket?
Well, look, certainly the ability to buy another property is out there, but what you've got to make sure is that it's a separate arrangement. So you can't just replace your existing property with another property.
Right.
You need to go out and set up another trust arrangement and indeed another borrowing arrangement. So you may very well find that your self-managed superannuation fund has multiple limited recourse borrowing arrangements in there over multiple properties, but you can't have more than one asset per arrangement.
Right, that's one of those little pitfalls, obviously, that is going to challenge people along the way. As we get towards the end of the loan cycle, what do we need to start thinking about at that point?
What we need to look at that point in time, because the legislation basically allows the super fund to take the title of the property away from the holding trust once it has extinguished its loan. It's a right, but it's not an obligation. So one of the things that the super fund needs to take into consideration is what potential stamp duty implications are there on transferring that property over. At what stage in my, I guess, superannuation life cycle am I? Am I in accumulation or pension, and what are the potential capital gains tax liabilities if I don't want to transfer the asset into the name of the super fund and indeed sell the asset from the fund.
And so I'm still in accumulation, and what capital gains am I paying? What rate?
All right. Well, generally, a super fund or self-managed super fund that has held an asset for longer than 12 months will pay a capital gains tax rate of 10%,
which is a serious advantage for the vehicle.
Yeah.
And once I'm in pension phase?
Once you're in pension phase and all the assets of the fund are supporting a pension, then the appropriate tax rate is zero. So clearly, once in pension, to sell down the asset is a fairly significant tax advantage.
So I am in that position where I'm about to pay up my loan. Do I have to move the property? Can I just leave it exactly as it is? Who's going to tell me off?
Yeah, well, look, that's a really interesting question, Tim, because at the moment, the way that the tax office interpret the law is that when the loan is repaid, the super fund either has to acquire the legal title of the asset, or the asset will be considered an investment in a related party. And we have restrictions that you can only invest in related parties up to 5% of the value of the fund.
Right.
And so you could create a significant compliance issue for the fund if you don't transfer that property title from the holding trust into the name of the super fund. But this is one of the areas that we're still, seeking further clarification from the regulator, which makes it that little bit more difficult and really requires people to ensure they get their advice up front when looking at these styles of investments.
And the little bit in there, of course, is you get audited annually?
Absolutely, yes. So as a self-managed super fund, you must appoint an auditor.
Yes.
And that auditor is effectively the watchdog for the tax office. So you have your accountant or your administrator prepare the returns. The fund is then audited, and then it's reported to the tax office whether the fund's doing everything properly, or if there are any slight issues that are potentially not in accordance with the law. Okay.
So I guess what you're saying, pardon me, is that there's a balancing act at that point where you might be balancing the potential cost of stamp duty to transfer from that entity into the actual super trust.
Yes.
As opposed to the capital gains tax impost in accumulation phase.
Yes.
Is there a formula? Is it or is it just the simple math? And
Look, it can be a formula, but it can also be a location issue because the stamp duty rules are different in every state. And of course, we're talking superannuation as a Commonwealth law,
yes.
but stamp duty is a state-based law. So effectively, it depends on where the property is as to what the circumstances may be. And who knows, there may be a change in South Australian stamp duty laws that removes that stamp duty impost when you transfer from the bare trust.
Okay, well, that's very interesting. The last question I had was in regard to, I guess, the stamp duty and is there a point in time, if I was entering into this sort of an arrangement, where I can fix it so that I don't have to pay stamp duty?
Look, I guess it's one of those things that realistically you should be trying to make sure you get all the steps in place right from the outset.
Yep.
So ensuring that all the initial deposit is paid from the superannuation fund, that all of the repayments from the loan are made from the superannuation fund. So from a stamp duty point of view, that if there is any determination to be made as to who the real purchaser of the property is, everything points towards the superannuation fund. Trying to fix things throughout the term are more likely to create problems and therefore the potential of a double stamp duty scenario.
Right, okay, well, Tim, that's been very good. We are now going to go behind the blinds.